Option contracts that expire worthless with no value are awesome. And it's because they... If this is your first time on my channel, welcome. I'm just a random guy that publishes videos on YouTube sharing my experience using a simple option trading method. So I'll be sharing selling option premium for a living. Now, if you're already a subscriber or you've seen any of my previous videos, then maybe you already know my story, my background, and where I'm coming from and how I got started selling option premium. But if you don't know and you're unfamiliar, it might be worthwhile to take a minute, go back and watch some of my earlier videos just so that you can see where my background is and how I got started. So my life journey took me on this path, and now I'm selling option premiums for a living. So for me, the benefits that I've identified and what I really enjoy is that I'm able to work online and generate an income. And because I am working online, that means I get to work from home. I don't have to go into an office. I don't have to fight the commute, driving back and forth to work every day. These are two huge benefits that I derive by selling option premiums. Okay, and I can't talk about the benefits without also talking about the things that I don't like about selling option premium. And I guess the first number one thing that I don't like, this is very much an active income activity. For those of you familiar between the difference between active income and passive income, you'll understand immediately what I'm talking about. So it comes down to this. If I'm not watching the markets, doing the research on the stocks, and identifying which option trades to get into, if I'm not doing any of those activities, then there's no way for me to generate an income. Whereas passive income activity in the stock market involves something like buying and holding a stock and gaining the profit from stock appreciation, or also owning stocks and receiving the monthly or quarterly or yearly dividends that those stock ownership pays. The other downside to selling option premiums is that it can be capital intensive. And what I mean by that is there are some trades where it's just too expensive for me to get involved with. For example, I can identify the opportunity and see the trade. However, I just don't have enough money to get involved with it. So I have to start smaller and work my way up. You may be familiar with the expression, it takes money to make money. And that's definitely true with selling option premiums. But if you watch some of my earlier videos and some of the challenges I've taken, you've seen that I've sold option premiums using a small account of $500 or less. And in fact, I've demonstrated some option trades with only $250. So it's completely possible to start with a smaller account, collect profits, and work your way up to higher and higher values. So in part number 1, I'll be discussing the strategy of selling option premium. And so basically, you'll learn about what I do to sell the option premiums. And then in the second half of this video, part 2, I'm going to share with you some live examples. So then you'll be able to see exactly how I do it. My strategy utilizes two methods of selling option contracts. First, I sell cash secured puts. And then second, I sell covered calls. Now, I want you to pay attention to the first words in both of these. It's all about I sell. And the reason I like that is because whenever I sell something, it means that I receive money. Now, I get a lot of comments from viewers and subscribers that ask me, hey, how come I'm not buying calls or I'm not buying puts? It's because when I buy, it means I have to pay money. And my goal here is to actually make money. So I want to receive it. And so that's why I concentrate on selling cash secured puts and selling covered calls. Next, let me show you how each of these works. So I'm going to walk you through selling a cash secured put and how it works. So on the left-hand side, you can see me. And on the right-hand side, you can see the stock market filled with buyers, or actually one buyer in particular. So on day 1, I'm going to write a cash secured put option contract. And remember, so this is going to have an underlying stock. In this case, it's going to be ABC Incorporated. It'll have an expiration date. In this case, it's going to be a 1-month expiration, so 30 days out. And it's going to specify a strike price. So for our example, this cash secured put is going to have a $100 strike price. Now, in order for me to write this cash secured put option contract, I need to have enough cash on hand reserved as collateral in case the shares get assigned to me. So I'm going to have some money reserved and stored as collateral in case the shares, the ABC Incorporated, get assigned to me. At this point, I'm going to offer this option contract available on the stock market. An interested buyer is going to see it, and what they're going to do is signify that they want to purchase it, and so they're going to pay the option premium to me in exchange for the contract. And so that the transaction will take place, I'll receive the premium, and then the buyer gets their name added or associated with the cash secured put option contract that I sold to them. Now let's skip ahead and go to day 30. What happens on expiration? Well, one of two things can happen. Number one is that the market price for ABC Incorporated could be below the strike price. So in this case, the option contract would be exercised. And so my collateral, the money that I had reserved, that's going to be used to purchase 100 shares of stock. And so my collateral will go in and I'm going to receive 100 shares of ABC Incorporated. So now I'm going to be the owner of record of those shares and I'll get to keep the premium. Now in the other case, the market price is going to finish above the strike price on expiration date. And so when this happens, the actual option contract, well, that expires worthless. Additionally, my collateral is returned back to me. It's released back to me. So now it actually never left my account, but it's now no longer reserved. And I get to keep the premium. So here's what I want you to notice. In both cases, I was able to keep the premium, no matter what happened with the strike price or with the contract. So this is one of the methods that I use to generate an income by selling option contracts. Next, let's look how a covered call works. So again, we start off with me on the left and the stock market with buyers on the right. Now I'm going to create a covered call option contract. I'm going to use an underlying stock, ABC Incorporated. I'm going to specify a 1-month expiration date, and I'm going to put a $100 strike price as part of this option contract. And the reason I'm able to write this covered call is because I actually own 100 shares of ABC Incorporated, the company's stock. So this allows me to use that as collateral against the option contract. Now, once I've done this, I offer it for sale on the stock market, and then an interested buyer will let me know that they want to buy my option contract, and so they're going to be willing to pay the premium for that option contract. So I receive the premium, and the buyer then takes ownership or is retained or is associated with the option contract. And now let's skip forward 30 days to the expiration date and look at what happens. It's going to be one of two things. So the first result is the market price finishes above the strike price. So in this case, the option contract is going to be exercised. And so my shares will get assigned to the buyer, and I'm going to receive payment for those shares, and I get to keep the premium. Now, the other result could be that the market price finishes below the strike price, in which case the option contract is going to expire worthless. And I'm going to retain the ownership of those shares, so I don't have to give them up. So that's something I want to point out. I keep the premium in both of these cases. So let's do a quick review of the two methods I just shared with you. The first one is a cash secured put option contract. Recall that as collateral, I had to have the cash reserved and saved in my collateral in case the shares got assigned to me. And when I put the option contract out on the open market, an interested buyer would pay me the premium. In return, they would be named and given access to my cash secured put option contract. Next, let's look at the covered call option contract. So for this one, the collateral behind it was the fact that I own 100 shares of the underlying stock. Again, as I place it on the open market, an interested buyer would pay me the premium in return for being named and receiving the option contract. So if we look at both transactions, the key here is I keep the premium from both transactions no matter what the disposition is of the option contract. So that concludes part one. I showed you the two different methods I use for selling options, both the cash secure put and the covered call. Now, those are high-level overviews. I didn't share all the intricate details, such as researching and picking a stock, determining an expiration date, picking a strike price, and things of that nature. But I gave you just enough to understand the two different methods. Next, let me share with you some examples of how I've actually used these different methods to execute some trades and generate some income. So let's start with an example of a cash secure put. I've opened up my Robinhood account, and I'm going to go over to settings and take a look at my account history and find a transaction that we can use for this example. I'm going to use this transaction here, a cash secure put for NEO Incorporated, stock symbol NIO. I'll select it to open it up so we can get the details of this transaction. Then I'll zoom in to make it a little bit easier for us to read through. This transaction is for a cash secured put for stock symbol NEO. The strike price is $40 and the expiration date is 11/20 of 2020, so November 20th. Next, we can see that the order was filled on November 16th, 2020, so this is a 4-day option contract. Next, we can see that when the contract was filled, the limit price was $3.60, which means that for selling this cash secure put, I received $360 in premium. Now let's go check out a chart to see where the NEO price ended on November 20th, 2020, when the option contract expired. Here's a chart for stock symbol NIO, and it's focused on the closing date of November 20th, 2020. Now let's zoom in and check out the closing price on that day. So from the chart, we can see that NIO closed at $49.25 on November 20th, 2020. So this means that the market price closed above the strike price, the option contract expires worthless, so the money that was reserved as collateral is released back to me, and I get to keep the $360 of premium. Now let's look at a recent trade I made selling a covered call. I recently sold a covered call for NIO, stock symbol NIO, and here's the transaction in my account history. Let's go ahead, open it up, and take a look at the details behind this transaction. So let's take a look at the details of this transaction. It's for stock symbol NIO, and the company is NIO Incorporated, so it's one of those EV stocks. So I already own 100 shares of this stock, so I am selling a call, and because I own the shares, it's a covered call. I specified a $57 strike price and an expiration date of January 8th, 2021. And if we move towards the bottom of the transaction in the middle, we can see that this order was filled on December 31st, 2020 at 12:56 p.m. Pacific Standard Time. And when this contract was filled, the limit price was 72 cents. And at 72 cents per share times the 100 shares for the contract, that means I received $72 in premium. Because today is Thursday, January 7th, 2021, we'll have to wait until the closing bell tomorrow to see where NIO stock ends up. So if NIO closes above $57, which is my strike price, my shares will get assigned and I'll receive $5,700 in return for my shares. I get to keep the $74 premium, and with my cost basis, my return on the investment is 28.3%. But what if on January 8th, the market closes and the stock price is below my strike price? What happens then? So if NIO closes below my strike price of $57, then the option contract expires worthless. I end up keeping my shares, and I also keep the $74 premium. I don't know about you, but I'm going to be watching the price of NIO when it closes on January 8th, 2021 to see where it finishes up, so I know exactly how this trade will finish. If the market price finishes above my strike price, that's okay. That's 28.3% profit, and I'll take that money and reinvest it and use it to grow my account even larger. But if NIO finishes below $57, that's okay too, because I plan to reinvest those profits as well and continue to grow my account larger. So where do you think the NIO price will close? Leave me a comment below and let me know your guess. But hurry up with your guess. You need to submit it before the closing bell on January 8th, 2021. So I've been able to share with you my strategy for selling option premium to make an income. And specifically, the two methods I use are selling cash secure puts and selling covered calls. If you enjoyed this video, please do me a favor and smash the like button. It helps the YouTube algorithm, and it also helps motivate me to make more videos like this one. If you're still watching this video, I just want to say thank you so much. I know that you're a true fan. And because of that, I want to wish you good luck and lots of success with all of your trades.